Welcome everyone. We're just going to wait a minute or so for everyone to join. Thanks. Welcome all. We're just going to wait a couple of seconds for a few more people to join and then get started. So tēnā koutou everyone, my name's Cath Lomax and I'm the Chief Client Officer here at Fisher Funds. So a very warm welcome to you this afternoon. Today I'm joined by Ashley Gardyne, our Chief Investment Officer, and Dave McLeish, who is our Head of Fixed Income for the webinar today. So Ash, Dave and I are all in Auckland in level 4, and we've got offices in Christchurch and Wellington that are living the lifestyle in level 2. So we hope wherever you are in the country that you're keeping safe and well. So as many of you know, we help our clients with managed funds and KiwiSaver, right from when they're starting out through into retirement. And that's through our great investment returns and our investment processes. And that's what we're going to hear from Ash and Dave about today. So we really encourage your questions. You'll see down the bottom of the screen, there's a Q&A button. So if you can ask your questions, we'll do our very best to answer them as we go along. So just a couple of things before we get started. So today is information only. It doesn't take into account your own personal situation. However, we do have a great team of advisors and lots of information on our website as well, so you can check that out. The other thing is the webinar is being recorded, so if you need to leave early or you want to revisit it again, which hopefully you do, then you can do that. And then lastly, your participation cannot be viewed by anybody else, so just the panelists here. So I think we'll get straight into it. And I'm going to ask a couple of questions, Ash and Dave, to start with, just a little bit more about Fisher Funds and our investment processes. So Ash, there's been a lot in the media lately around passive versus active. So can you tell us a little bit about smart active investment and really what does it mean and what are the benefits of that?
Great. Well, thanks a lot, Cath, and welcome along, everyone. It's great to have so many on the line today. I can already see questions coming through in the Q&A, so we're looking forward to jumping in and answering some of them shortly. But Cath, just on your first question on active management, it's a really important one because there is a really big difference between active and passive. A passive manager essentially tries to buy a little bit of every stock on a share market, and what they're trying to do is replicate the share market return. What an active manager like Fisher Funds, by contrast, is trying to do is trying to buy a very select portfolio of just maybe a handful of companies with the intention of delivering higher returns over the long term. And active management really is what is at the core of what Fisher Funds does. We have a team of 25 analysts and investors that are searching the globe for the best investment opportunities. And it's just one example, the International Growth Fund that I manage, we have about 22 companies in the portfolio currently, companies that you'll know like Amazon, PayPal, and Google we've owned for many years. And the intention of that is to create a portfolio of just really high quality businesses, and that's allowed us to outperform the market over the long term. And why that's really important and why active investment is really important is because in this low interest rate world we're in at the moment, any extra bit of return you can earn over and above the market return certainly goes a long way to help you build wealth for retirement.
Yeah, that's great. Thanks, Ash. And welcome, Dave. I'm going to throw a question to you just to warm up. So you've been with Fisher Funds for a little while now. I won't necessarily share how many years, but what do you enjoy most and what do you think really differentiates Fisher Funds?
Thanks, Cath. I'd just like to say how great it is to connect with everyone today. Being back in lockdown really has been a pretty brutal reminder of how important social interaction is for me. So although, it's a virtual get together and there's nothing like the real thing, it's still great that we're obviously coming together. So, really appreciate the opportunity. But yeah, Cath, I guess the answer is, I suspect people think that I'm part of the furniture these days at Fisher Funds. So yeah, gone through 10 years. But really, what continues to excite me and motivate me is our culture. Culture is a difficult thing. The way that I like to think of it is that it's really just an expression of our goals through the values and beliefs that we have. But most importantly, it actually really guides our actions, and that's more specifically through those shared assumptions that we have as an investment team here at Fisher Funds. So, most of the listeners will probably know that Fisher Funds aims to create epic futures for our clients. We think that they can be achieved through a combination of superior investment returns, of course, but also by sharing our knowledge to help people make better investment decisions throughout their lives. The shared assumption that I talked about there is that neither of those things are really possible without an environment that's open, inclusive, and actually values learning. And that's really the important bit for me. We love obviously sharing knowledge with the outside world, and that's what we're doing today. But actually sharing knowledge and learning from each other inside of our team is essential to creating those great investment returns. I'm hugely proud of all of the individual teams' capabilities, but really what inspires me most is that sense of unity and that teamwork and that drive to I guess the common goal that we've got.
Yeah, that's fantastic. Thanks, Dave. And we're getting lots of questions coming through. So we're going to spend about the next 30 minutes answering as many as we can. So I'm going to go straight into one for you, Ash, which is around how are markets performing in lockdown, and how does that compare to last time?
Yeah, and it's a really good place to start the investment discussion here, because things are certainly a lot different, particularly in markets, than they were last time we were in level 4. I guess the only thing that's sort of similar to last time around is perhaps the environments at home. The kids are getting sick of my homeschooling, and we're probably all watching a bit too much Netflix in the evenings. But from a market perspective, it seriously couldn't be any different. This time with level 4 last year, markets were extremely volatile. We'd seen the fastest ever 30% plunge in both the New Zealand market and the US market. This time around, we're seeing markets hit all-time highs. Both the NASDAQ and the S&P 500 in the US have recently hit highs. So the question is, why are markets hitting highs despite the fact that we've got a lockdown and despite the fact that COVID's still out there? And the reality is a lot of the investor anxiety has dissipated. We've seen people learn to deal with this, and we've seen businesses still perform pretty strongly. And ultimately, we've seen light at the end of the tunnel with vaccines and other markets around the world reopening. And actually, if you look to Europe and the US at the moment, people are off on their summer holidays, and there's something for us to look forward to at some point there as well.
Yeah, no, that sounds good. And so for Ash, if global markets are hitting all-time highs, what has been some of the implications for the New Zealand market from this most recent lockdown?
Yeah, it is really interesting. It's actually a really similar story closer to home here in New Zealand, despite the fact that our level 4 lockdowns are quite sort of tight lockdowns compared to what we've seen in other parts of the world. But the initial market response was a bit of concern. So we saw the New Zealand dollar sell off a couple of cents over the first couple of days. That was about 3.5 weeks ago now when we went into lockdown, but it's since gone on to fully recover. And I guess what traders were looking at with the initial fall in the currency there is they thought level 4 lockdown would impact our economy. It would potentially pull down interest rates and the dollar with it. But we've actually seen interest rates rebound extremely quickly, and they're now back above where they were pre-lockdown. And Dave will probably talk a bit more about that later on, about what the Reserve Bank's up to. But also the New Zealand share market, the NZX 50 is up about 4% since lockdown as well. So really a different response than we might have expected. But the reality is, part of the reason for that, we've had a really strong corporate earnings season throughout that period. Companies like Somerset have delivered some great results, as have Freightways. And Freightways is perhaps a really good example, because in level 4, we know their operations are severely impacted. But once the country returns to level 3, you actually quite rapidly see their volumes bounce back and actually return to growth, because everyone starts shopping online. So actually, the big point here is people are generally, and it's quite an important lesson, people are starting to look through the impact of COVID and short-term impacts. And I think over the last year, people have really learned that taking knee-jerk reactions to short-term events isn't a great thing in the world of investing, but thinking a little bit further ahead, looking at the growth prospects of the businesses you're investing in and hanging in there for the long term really pays off.
And that actually kind of ties in really nicely with a question that we've come through, which is around when the value of our investment drops, is it still a good time to invest? And we get a lot of the advisors get a lot of calls or emails or talk to their clients a lot around when is the best time to invest. And I think it's quite an individual thing, but obviously there's times when it's a good opportunity to look at what's happening. And at the moment, our business is as usual during this lockdown time, and it's a great opportunity. I think people are really thinking about what am I doing, what should I be doing, and having a little bit more time, maybe not just watching Netflix, Ash, to think about their investments. So I really encourage anyone to give us a call, talk to your advisor, to discuss your own individual situation. So David, a question here for you is, and I think this relates to what you were saying as well, Ash, is interest rates in New Zealand haven't moved as much. One implication of the lockdown was the RBNZ not hiking rates a couple of weeks ago. So can you talk us through about RBNZ, why the RBNZ was going to hike and when this may be back on the agenda?
Yeah, sure thing. You're right there that the Reserve Bank is very keen to move the official cash rate higher. It's clear that they view this current, the official cash rate today stands at just 0.25%, so a very, very low rate. And they clearly do view that rate as this emergency setting that they put in place through the pandemic of last year. So they certainly don't believe that that's now justified given how strong the economy is, or I suppose at least was going into this current lockdown. But what was really interesting was in that monetary policy statement of last month that you mentioned, Cath, the bank actually talked about that the economy was already at or above its long-run sustainable level of employment. So that really is a very rosy assessment of the economy. And what's even more interesting is actually that the Assistant Governor Hawkesby and the Senior Economist Yun Ha have actually felt so compelled that they've come out in more recent weeks, even as the lockdowns kind of persisted, talking that same message. So they really are quite eager to raise rates. The next decision is August 6th. So that meeting, I suspect, is what we'd call very live. So they certainly could raise rates then, especially given how much they're kind of playing down the impact, or at least the long-term impact in particular of the lockdown that we're currently in.
Did you say August the 6th, Dave? Or?
Oh, did I say August? I meant October.
You did, but I think you did, but that's okay.
I meant October.
I thought you did. No, that's okay.
Well done for picking me up.
Oh, all good, all good. So I guess what does that really mean for investors, Dave? A question here, when could they get back to, if they've been low for a long time, when could they get back to, and what does it really mean for our investors?
Yeah, well, you're trying to sucker me in there, Cath, I think. I actually, for the listeners, I wrote an article recently called The Folly of the Forecast, and that was just suggesting how terrible people really are at making predictions, and that's even especially those that are supposed to know a little bit about the topic. So I'm not actually going to fall for that trap and profess to know what I'm actually, what lies ahead. But what I would say is that the New Zealand economy is actually more sensitive now to changes in interest rates than many people actually expect. And that's largely because there's been this huge build-up in household debt over recent years. And the best way to kind of depict this is actually through an example. The last time the Reserve Bank set out on raising interest rates was back in 2014. They managed to raise that official cash rate that I was just talking about by just 1%. So that would take the current rate of 0.25 up to 1.25%. They could only raise it 1% though back in 2014 and had to stop because it slowed the economy down too much. Now, since then, household debt has actually risen by 60%. So, to answer the question, Cath, I'd be pretty surprised if the Reserve Bank does actually fulfill its promise and take the official cash rate up to over 2% by 2024, which is what they're currently forecasting.
Yeah, okay, that's great, thanks. A question for you, Ash, which we actually had come through from one of our people on the webinar that came through last night was, given the increase in cyber attacks, what measures are in place to protect Fisher funds? Which I thought was a really good question.
Yeah, it's certainly topical. We've obviously seen some press in the last couple of days about increased cyber attacks on New Zealand banks, and I think New Zealand Post as well. But we obviously take cybersecurity really seriously, and the protection of our systems and our client data as well. So it's something we've spent a lot of time on, a lot of money, and put a lot of resource into. So we do have a team that's responsible for this and managing all of our capability there. We have implemented a lot of specific technology and enterprise software in the security space to protect our systems, both our network and our data and our clients' data. And then on top of that, we do have 24/7 monitoring and security, not only of our systems, but sort of alerting when there is a pickup in this activity across the broader market, so we can be extra vigilant. So there's some things at the IT level, but we also have training across the business for all of us, not just the IT team, for the whole firm, to make sure we look out for anything suspicious that could be trying to compromise our system. And then really importantly, on the funds side, we obviously have several layers of verification for our clients, and we can only deposit funds into accounts that have been pre-approved, and to make sure they are the appropriate accounts. So there's multiple levels of this, but I guess then importantly, on top of that, we also have annual independent testing of all that to make sure it actually works. But more importantly than all of that probably is the space is going to keep evolving over time. The sophistication of these attacks continues to evolve as well, and we're just going to have to keep moving our systems every quarter and every year to continue improving as well.
Yeah, no, that's great. Thanks, Ash. We're getting a few questions, lots of questions coming through, which is fantastic. We're getting some about quite individual, what should I be doing? So just encourage anybody after the webinar that wants to be in touch, just give us a call or email us, and we'll be happy to really help you out on an individual basis with any of your own questions. So I'm going to ask Dave this question, which is, are you considering offering ethical funds or funds with a particular focus on ESG or sustainability? And I know that's quite a hot topic at the moment also.
Yes, no, it certainly is. I've seen quite a few questions already come through on that same sort of topic. So I'll make it a few, rather broad statements. But what this really boils down to is that there certainly has been a strong movement towards responsible investment practices, and I'd say that we're really proud of being strongly aligned with that. We take a three-pronged approach, and that is one, we exclude, second, we embed, and third, we engage. So I'll just sort of walk through each of those individually. Excluding, we have an environmental, social, and governance. That's what ESG stands for. We have a committee that actually consists of team members that are appointed by our CEO, and those members come from all over our business, not just the investment team. They come from client services, they come from the wealth team, etc. And we think that improves the diversity of thought, especially when it relates to things like ESG issues, and that also enables our clients, to give us feedback and to allow us to incorporate that into the committee's deliberations. The committee, and where the exclude bit comes from, is that the committee kind of adjudicates on an exclusion list that effectively eliminates certain industries and companies from investment. And those exclusions are judged really through a lens of how much harm they cause, whether that be on an environmental or a social side. But and currently that exclusion list includes fossil fuel extraction companies, so oil, gas, coal. It excludes tobacco, weapons, and gambling or gaming companies, and that list is actually available on our website, and it's updated quarterly, so please feel free to have a look on there. But secondly, ESG factors are deeply embedded actually into our investment process, and they have been for many years. One of the real defining features, I guess, of the Fisher Funds investment style is our deep fundamental work that we do on each investment that we put inside of any portfolio we manage on behalf of clients. And as part of that research that we do on those investments, ESG has a very clear place in that. And actually, to support all of that in-house analysis, we actually employ an external ESG expert, MSCI, to help sort of cross-check some of those key considerations. I would just kind of be very clear, though, that responsible investing policies and procedures of ours are ultimately a Fisher Funds decision. We very much own that investment process and those outcomes. And then finally, we engage. This is again very a unique kind of defining feature of Fisher Funds. Again, because we are so close with the investment companies, we are able to engage with them in a pretty detailed and regular manner. That gives us the ability to provide what we think is some pretty strong and positive voice on aspects of ESG and really all those matters. And then that allows us, whenever there's a discretion or any corrective action that has to take place, for us to obviously front foot that and engage with the right people inside of those businesses. So that's a long answer, I know, but ESG is pretty damn important to us. We don't have any segregated funds that are particularly socially responsible. We embed it into all of our process and all of our funds.
Yeah, and I think that's great. Thanks so much, Dave. I think it's really important that people, and clients understand how it works. So that's great. So Ash, I've got a couple of questions for you. One is around how active is active investment. So the question, we invest elsewhere as well. At the beginning of the pandemic, they sold out of some assets that were likely to be affected badly, such as airports and airlines. Do Fisher Funds react as actively as that?
Yeah, no, it is a really good question, because active can actually mean different things, and yeah. we don't. Our aim isn't to trade a lot. We tend to try and find the right companies to buy and hold for the long term. So generally, we buy things and hold, with a 5 to 10 year holding period. But then there are periods in time where actually markets move a lot and you get a lot of opportunity. And a great example here is in the International Growth Fund. This is the company I mentioned earlier that owns PayPal and Amazon. We've held some of the companies in the portfolio for 10 years. The New Zealand portfolio has held certain companies for 20 years. But in the depths of COVID, we actually found a lot of opportunities, and some of our more defensive companies, for example, our healthcare holdings, had held up extremely strong back in March and April last year. So we were able to sell them and buy other companies that had been quite severely impacted by COVID in the short term. A great example would be Hilton Hotels or Starbucks. People thought for a period there no one would ever go to a hotel again and no one would ever buy coffee from Starbucks again. So there's some great opportunities there to occasionally pivot your portfolio in response to really big market moves. So we were very active through that period. But then again, since then, we haven't been as active again. We've got this portfolio of companies that we love, and the thing to do is really just to hold them over the long term, and that will be how we generate good returns for our clients. So the answer is it depends on the market, but we don't trade a huge amount, but we're really active when we have to be.
Yeah, that's great. And that's actually answered a couple of questions that have come through here. So that's fantastic. Thanks, Ash. The second question is, it says, it looks like American SPAC firm activity has been going absolutely crazy in the last 12 months on the back of funds being locked up in COVID. This is creating a lot of investment in non-cash generating companies at ridiculous multiples. How resilient are your growth investments from that inevitable correction that will come?
Yeah, no, it's a really good question, because there is some really odd behavior in markets, and SPACs is a way of listing companies on the market without having to go through a full regulatory process. But there are other really interesting things out there, like all the excitement around electric vehicle stocks or genomic stocks or cryptocurrencies. And then you've got the trading in meme stocks like GameStop. So there's all this really crazy stuff happening in markets. And so the question is a really good one. Are we in this big bubble that we should all be really concerned about? And how close is this to what we saw back in 1999? And I think these are all really good examples of areas where we think there really are excesses in markets. You need to be careful. But all that said, what I think is different this time is back in 1999, the companies that were getting caught up in this frenzied activity weren't small companies like GameStop or these small electric vehicle companies. They were the biggest companies in the market. So at the time, Cisco, America Online, Microsoft were all trading on ridiculously high valuation multiples, and they were the biggest companies in the market. If you look at the market now, the biggest companies in the markets like Apple and Facebook and Google, we actually think they're really quite fairly priced for businesses that are really great businesses and growing quite nicely. So we think there are parts of the markets that are just fine, but there are these pockets where there's real excess and certain parts of the market where there is a bit of a frenzy. So I think you just have to avoid certain parts of the market, but if you do that, I think you can still do quite well. And I think that comes back to what we said at the start, the whole active management thing. We don't have to own the whole market. We just invest in a few selected companies that we think we have good growth and are fairly priced, and we'll just ignore everything else.
Yeah, no, that's great. Thanks. There's a question here around inflation, Dave, which would be a good one for you. Are you worried that inflation won't be temporary, and how does Fisher Funds expect to manage that risk?
Yeah, sure. That's there's certainly a lot of debate about that one right now. So very topical. Again, I'm going to give it a little bit of a health warning that I don't have all the answers on this one. But history does suggest that if inflation really isn't as transitory as many might expect, then there will be certain assets in your portfolio that will perform better than others. The ones that will typically perform the best in that environment are equities or shares. They perform pretty well in most inflationary environments, especially for those sorts of companies that can maintain their pricing power, which is their ability to be able to pass on extra costs or the costs inside of their business into higher prices to their consumers. So you'll hear us talk about companies like that have got this pricing power quite a lot from Ash and my other equity colleagues, because that's a pretty key factor that we look for when we're trying to select equity investments. And obviously, even just very recently, interest rates have continued to rise, which has put downward pressure on the valuations of fixed income assets like bonds. So those are typically the assets that perform the worst in an inflationary environment, and that's largely because the buying power of the static amount of income that we receive from these types of investments just gets eroded away by inflation. So there's no kind of easy answer for an investor that's not entirely comfortable with investing purely in, say, growth assets like shares. The answer is more putting together a diversified portfolio, and that would be, for example, our conservative funds have a balance between those income generating and growth assets. Conservative fund typically has about 70% in income and 30% in growth, and that portfolio over the last year has generated about a 5% return, so in excess of inflation.
Yeah, that's great. Thanks, Dave. And actually, it ties kind of nicely into a next question, which is, if a correction in the market is expected, should we exit the market for safer investments like cash? Which is a really good question that the team gets. So, I mean, we really encourage our investors to stay the course. If they've put a plan in place with their advisor, they should stick with that. The advisor would have talked through what the ups and downs and how you respond. But obviously, during these times, people can get anxious, or worried about things, and we just encourage you to have a chat to your advisor and work out what the best thing to do is. But we try and avoid those knee-jerk reactions to something and look at the longer term picture. So that's great. Thank you. Dave, there's another question for you. I'm on a flow here. So to what extent do you use currency hedging to manage currency risk?
Okay, yeah, sure. So we don't, within our fixed income portfolios, I'll just touch on that specifically because that's kind of what I oversee, but we typically hedge away all of our currency exposure in our fixed income portfolios. So the benchmark is 100% hedged. What does that mean? It means that basically any variability in the exchange rate between, say, the New Zealand dollar and the currency of the investment that we're making is reduced to to zero or very close to zero by using derivatives to take the other side of that exposure and reduce it down to zero. So we don't typically use currency inside of our fixed income portfolios. In our multi-asset portfolios, so the ones that I just mentioned, like a conservative strategy that has some growth and some fixed income, there will be times when we use currency, but typically to a very small degree. It's only really if we're trying to reduce the risk, if we feel as though there is some specific risks that we want to reduce out of the portfolio, we'll use currencies to do that. But typically, you'll get from us pretty high conviction portfolios that are focused on generating returns associated with picking the right companies to both invest in from an equity perspective, as well as the ones to lend to from a fixed income perspective.
Yeah, no, that's great. And there's a whole pile of questions here. So we'll keep going on these, which is great. But remember, if we don't get to your question through the webinar, we will be in touch afterwards, or feel free to touch base with us. Ash, I'm going to go to you and give Dave a break for a little bit. So we've probably got about 3 or 4 questions each here. So does Fisher Funds actively engage with companies they invest in at AGM time? So, for example, voting on the AGM resolutions, such as election of directors, CEO, etc. That was a great question.
Yeah. No, it's a great question, and absolutely, and part of that comes back to what Dave was talking about earlier on the ESG and governance, and making sure companies have got the right governance in place, and that we're involved in that. And in markets like New Zealand and Australia, where we're obviously a big operator in New Zealand and have large stakes in companies, we have a higher level of engagement there. And Sam, who runs our New Zealand strategy, will meet with companies very regularly, talk to the CEO, talk to the chair and the board of those businesses, and be highly involved in providing our thoughts there. If there are anything we're unhappy with that the business is doing, and if there are any things that the ASM we need to bring up, we'll absolutely do that. So absolutely, we definitely engage heavily in New Zealand, also in Australia. As we move internationally, obviously our voice doesn't go as far when we're voting on Facebook or Google, but we certainly still make our points heard.
Yeah, no, that's great. Thanks. I'll ask you one about cryptocurrencies, and I know you kind of touched on that briefly, but would you look at including cryptocurrencies in your investment portfolios?
No, we get this question a lot. I actually got an email through today for someone on this about whether we're going to put it into our international growth fund, and the answer there is actually very easy, because we're only allowed to invest in companies. But if they ask the broader question, would Fisher Funds ever look at investing in cryptocurrencies? But my answer is still pretty similar. Look, we look to invest, the way that we invest is we like to invest in things that produce cash flow and grow over time. So companies that have a business that generates cash flow, they can reinvest that cash into their business and obviously grow the business through time. That's how you benefit as an investor. With bonds, there might not be the growth there, but when you invest in a bond, you have a contractual right to receive cash flows and coupons from that investment. So there's a real source of return. When you start talking about other things like cryptocurrencies or gold, for example, there's no cash flow associated with that. The valuation of that is effectively what others are willing to pay, and that's something that we're quite uncomfortable with. You want to ultimately own a share of a business, which, if you're correct on the thesis for that business and how that business will grow through time, you can sort of create some reasonable expectations about what your returns will be from that investment, and we feel a lot more comfortable there. But we know there's a lot of excitement around cryptocurrencies, but we're more than happy to sit it out for now.
Yeah, that sounds good. I've got a question here. How do I get in touch with Fisher Funds and start investing? So there's a few ways. Go through to our website. You can look at managed funds and KiwiSaver online, or call our number, and someone can either help you or call you back and get in touch. So very easy ways there. And Ash, I'm going to ask you another question here, which is around what opportunities do you see in the UK and Europe over the next few years?
It's a good question, and we so in our international growth fund, which flows into our KiwiSaver funds, we do have exposure to Europe. Most of our portfolio actually is in the US. With our investment style of investing in high quality growth businesses, we just tend to find more of them in the US, but there still are some great businesses in the UK and Europe as well. We are invested in a company you'll know called Adidas in Germany, which is a great business. We've had a large number of sort of German investments in Italy and the UK over the years. And an interesting thing about the European market is particularly right now, it is a little bit cheaper than the US market. So we are spending some time looking at specific opportunities there. The US market's had a really strong run, rightly so in many respects, because they do have some great businesses. But we are spending a bit of time, me and the team at the moment, looking at a couple of opportunities, specifically in the UK. I would say it is harder. There aren't as many great businesses in markets like the UK. Their market tends to be more sort of focused on services companies, and for example, financials, banking, insurance, oil and gas companies, mining companies. It's just the nature of that market and what's been attracted to the stock market over the years. Whereas in the US, you have Silicon Valley and you have a large number of great technology companies, and also, for example, healthcare and medical device companies that happen to be listed on the US. So we tend to gravitate there more, but we certainly still do have investments in Europe as well.
Yeah. And talking about further abroad, Dave, there's a question here around how concerned are you about the US potentially defaulting on its debt, and will we have a major correction?
Yeah, sure. That's a big topic. Short answer to my concerns around the United States government defaulting on their debt is it's pretty low. I think at this stage there's still the US dollar is still the reserve currency of the world, although that may change at some stage in the future. It's pretty entrenched in the banking system, and therefore, because they have control of that reserve currency around the world, it's very unlikely that they'll have to default on their debt at any point in time. Not to mention a pretty aggressive Federal Reserve that can actually can buy the government's debt and obviously keep them afloat for quite a considerable period of time. So that doesn't concern me too much, to be brutally honest, Kath.
And what about governments around the world increasing their borrowing by large amounts, affecting the investing environment?
Yeah, that's a different story. You're dead right. And so, certainly smaller governments, even like the New Zealand government, for example, does have to be a little bit more cautious with its debt levels, because they don't control the reserve currency of the world like the US does. And investors and alike can kind of give up on our nation if they believe that we're too indebted and we're too risky to invest in. So that could put a downward spiral on the Kiwi dollar, for example, and that could certainly get out of control. That's the same for a number of other countries. The fact of the matter is, though, is that actually the amount of debt that these countries can manage to sustain is considerably higher than a lot of the theoretical research of previous years suggested. We've got Japan running, well in excess of 200, nearly 300% of GDP as a debt burden, and still functioning perfectly fine as an economy. So you do have to keep an eye on it, and the smaller the economy, you probably have to keep a keener eye on it.
Yeah, sure. That's great. Thanks. I've got a great question here, Ash, around Rocket Lab and Allbirds. And I must say, during lockdown, I did order a pair of Allbirds, which arrived the next day to add to my collection. So US companies, are they of interest to investing in Fisher funds?
It's a great question, and it's great to see these Kiwi businesses succeed on such a large global scale. And I actually bought a pair of Allbirds the other day too, Kath, and they literally arrived in about 2 days, which was amazing. But it's a great question. I guess when we look to the US, what are we trying to do? We're trying to find the best companies we can in that particular market. I guess there are literally 40,000 different companies around the world that we can invest in, and we've sort of screened through them over time and created a list of companies that we think really are phenomenal businesses. A great example being Google or MasterCard. I think these are great businesses with many years of growth ahead. So we're very selective, and with both Allbirds and Rocket Lab, they still aren't that established. I know that Allbirds still isn't making a profit. They're in growth mode. We sort of like to wait to see who the established winners are. And a great example of that is Google and search engines. If you had invested early in all the search engines out there like Alta Vista and Yahoo and Excite and Lycos back in the late 1990s, you would have really come unstuck. We prefer to wait to see who the winner is, and we think there are still great returns from that point. So we've been invested in Google for about 10 years. It's been a great performer for us, but we were actually able to wait to see who the winner was first.
Yeah. And what about there's some questions here around, emerging markets such as India and other places from around the world.
Yeah, so we do have some investments in emerging markets in a number of our funds. The main investments we have in the International Growth Fund, or some of our biggest holdings, are in Chinese companies, Tencent and Alibaba. So we do look to emerging markets. It's not a huge part of our strategy, and part of that is because of the risks of investing in those markets. When we do invest in emerging markets, we really do stick to sort of the highest quality blue chips. Alibaba, a great example, the largest e-commerce player in China. But that still doesn't mean there's no risk around them. We're seeing that right at the moment. Alibaba and Tencent are coming under a lot of pressure with Chinese government regulations really ramping up in the last few months, and that comes part and parcel with emerging market investing. But we still think those businesses are great. They've got great long-term prospects, but there is a lot of volatility there at the moment, and that's why we try and keep the emerging market part of our portfolio reasonably small. We think there are great returns to be had if you pick the right companies in those markets, but you just have to be aware of the risks as well.
Yeah, absolutely. I think we've got a couple more questions coming through, and one for you, Dave, which is around the government borrowing billions to support business during lockdowns. How is this debt going to be reduced or paid back? And I think you did touch on this before, but maybe give us a little bit more flavour on that.
Yeah, sure. I think the government's actually kind of certainly from a social perspective has done the right thing, kind of bridging that gap between what was a very severe lockdown and kind of an economic shock to actually an environment whereby, we're kind of through that now. And you had to bridge that gap with borrowing money to inject it into the economy through, a lot of different programs which gave people the ability to be able to continue to, pay their rent or pay their mortgage or be able to still put food on the table. So the government, I think, made the right decision there by borrowing all these billions. The problem is yes, it does have to be paid back over time. The New Zealand government's actually, historically speaking, has actually done a really good job of paying back large debt burdens in the past. It does take decades. This can't kind of happen overnight. We have to keep the economy functioning, and you can't kind of tax it to the degree that it will slow the economy down entirely. But the New Zealand government actually has been very fiscally responsible for since sort of time began. So I do have confidence that when the economy gets back growing, it is already growing, but certainly gets back this head of steam, and we spend some time expanding, then obviously the tax take will be higher, and the government will be able to repay that debt over time.
Yeah, no, that's great. Thanks. And our last question for you, Ash, I think is, I know you mentioned before some of the companies in China. Is there any, with the regulation of the private sector for in China with the government, is it going to raise the risk profile for investing in China?
Yeah, I think that the risk profile has always been reasonably high investing in China. It's just at certain times you really see that manifest, and you actually see a large swathe of new regulations come out. The real crackdown in the last couple of months has been about sort of trying to improve equality effectively. So we've seen this sort of capitalist experiment in China now for 40 years. It's driven a lot of growth. It's pulled, I think, 700 million people out of poverty. It's been massively successful. But partly as a result of that, you've seen widening inequality. And I think you've now got more billionaires in China than you do in the US. And you're sort of starting to see some effects from that. And what the government now is trying to do is redress some of that and bring some more equality. And they're clamping down on a few companies that are perhaps profiteering at the expense of the broader population. And a great example here is in the private tutoring industry, which is effectively online tutoring for school students. In China, a lot of people will do the school, then they'll do after-school tutoring online, and then even weekend tutoring, all to get into to do really well on these university entrance exams. And that puts so much pressure on kids, pressure on parents financially, and actually hasn't provided much in the way of net benefit, because if everyone has access to that, then it's just an extra financial burden, but you're at no advantage when you take those tests. So the government's really cracked down on that in the last couple of months, and we've seen those share prices tumble. But it really has been a classic example of them trying to correct this inequality. And I think if you're a business over there that's doing the right thing and not unfairly profiteering and contributing to widening inequality, I think you'll probably be okay. But there's always this sort of risk when you're investing in China.
Yeah, absolutely. I might just slip in one quick question, Dave, and this will be our very last one. Fisher's fixed interest funds have shown negative returns for the last year. What is the reason for this, and when do they expect them to show a positive return again?
Sure. Yep. Tough question to finish with. Thanks for that, Cath. Yeah. No. As I was alluding to earlier, rising interest rates push down the value of fixed income funds and fixed income assets. So we've gone through a period really since November of last year where interest rates have started to rise and rise quite rapidly. So by that effect, if it's put downward pressure on the value of our funds. Certainly some of our fixed income funds have still actually created positive returns over the last year, even in spite of these rising interest rates, because they've been invested in other parts of the world maybe. But certainly the New Zealand fixed interest fund has had a tough time of it because of these rising interest rates. The answer to when is this going to turn around is a bit of crystal ball stuff. So I'm not going to fall into that trap. But what I would say is that there's two factors that you'd want to consider when you're investing in a fixed interest fund. The first one is that these higher levels of interest that we're already at now, so in fact the fixed interest fund's yield or income that it's expected to receive over the next year has nearly doubled in this last year. So the income that you can now expect from the fixed income fund is a heck of a lot better than it was a year ago. The second point is that as I've mentioned earlier, it really interest rates are really driven by things like growth and inflation. That's why we've talked a bit about inflation today. And just reverting back to my previous comments, I think inflation is getting close to its peak for this cycle. And if that does start to peak out, as I suspect it does, and we're kind of in this peak optimism phase, then I would suspect that these interest rate rises start to actually stabilize, start to plateau, and then obviously, they may start to fall again once the economy starts to slow back down again. Just like night follows day, the economic cycle will ebb and flow.
Yeah, no, that's great. And sorry to kind of finish with a hard question for you, Dave. But I have to say you talked about culture at the beginning, and that's one of the things that I really enjoy most about Fisher Funds is the culture with the investment team and the advisors. We have really good relationships. We can go and talk to each other. And so there's one last question, which is for me, which is when are we opening an office in Christchurch? And we have advisors there now. So we have Bevan, Nick and Amanda are our advisors in Christchurch, and so they'd be happy to talk to anybody that wants some more information. So a huge thanks to Dave and Ash. We've really appreciated all your insights. We've had a load of questions come through, so we've hopefully answered some of those, and there will be some more. As I said, please feel free just to get in touch and we will answer those for you. There's information on the website, and any feedback on the webinar that you have, please send it through. We'd be happy to hear what we can do differently or more of for next time. So have a lovely evening all, and thank you very much. Thanks.